We're starting to get into that volatile state where we're having 11, 12% rally followed by a very big sell-off the very next day. So if we just take a look here, you can see the market ran up over a one-day, 24-hour window, more or less 13% to the upside. And then today it has reversed down 11%. That is getting to be pretty extreme volatility. Big volume, that means there's some emotions, and that means capitulation. It could mean we're actually nearing the top. We did get close. Actually, I think we did. We hit an $82 target was my peak, and we actually hit that in pre-market trading or last night. I'd have to look at the taking a look at the charts. We got lots going on. Big price action in the precious metal space. I'm going to go into a lot of detail there in a minute, but let's just cover the equities markets first. Now, overall, if we just step back and look at the weekly chart, we talked about how the market had this big run. Sorry, the daily chart here. We had a big pause. It started to get unstable. We had a little bout of selling. We talked about running a whole bunch of stops. If we actually go and take a look at this 30-minute chart, we were talking about how we had this downtrend, and then we are going to look for the market to start to break some of these pivot lows. Every time there's a new little low, there's going to be some stops layered in here. And we had a whole series of these layered in, and the market ended up pulling back. It gapped higher, which we talked about that day is not a good sign. Usually it's an exhaustion gap. The market came all the way down. Every blue line here is where stops got run. We started to see some panic selling on our panic selling indicator. It followed through the next day into lime green territory, telling us it's oversold within an uptrend. So it ran all the short-term traders out, and then we went into the holiday rally, and we saw this little bit of a bounce, more or less from the low to where it closed on our previous session, about a 3% move. Not huge, but it did have that holiday bounce. You can see it on the daily chart here. We got a nice strong move, pushing up near or at all-time highs for the futures market. And now we're waiting, taking a little bit of a pullback today as the market takes a breather, and everybody's trying to regroup and figure out what is going on. Now, the NASDAQ hasn't got up to all-time highs. It came back up to another resistance area, taking a little bit of a pause, but it had done pretty much the same thing. It ran a little bit deeper, running more stops, more layers through here. And of course, the NASDAQ is a faster moving beast. It has a smaller pocket of stocks, which is one of the reasons why it does move faster. And it naturally pulls in people who are more aggressive, and more aggressive traders who are trading faster moving things creates more emotions. And that's why we get into bigger shakeouts, bigger moves when it comes to trading the NASDAQ. That's just kind of the way it is. As you go down to sectors, it becomes even more emotional. When you get to individual stocks, obviously stocks move much faster than an index or a sector, and it's a lot more emotional. So it just comes nature of the beast. When the smaller the group of stocks you trade, the more volatile it gets. But the same type of thing, we had a bounce up here. Now the big question is, where is this market going to go into the end of the year for the last couple of sessions here? And then, of course, January is probably going to be pretty wild and choppy. In fact, if we look at the seasonality chart for the indices, typically January is all over the place. And the big question is, typically, if January closes positive for the year, we see a positive year for equities. If it closes negative, we see a downward year. Now, there's a lot going on in this market. If we take a look at where I think we're trading, which is a stage 3, this is usually a topping phase. We have big divergence, and I'm going to show you an angle on 2007 versus right now that we might see a big difference actually in what's unfolding here. But I do believe we're going to go into a pretty big sell-off. Now, as you guys know, eventually we're going to go into one of these. This is the 2000 the 2000 tech bubble crash. This is in the SPY. Obviously, the NASDAQ pulled back a heck of a lot more. We also had the 2008 financial crash, and then we eventually stabilized and took off. That was a waste of 13 years. The NASDAQ was 16 years, lost more than half of your account. So one of these is coming. The nice thing is we do have a game plan, and we are and have been waiting for this for a long time. And it is going to be a life-changing moment when we not only avoid the crash, but watch our accounts continue to grow, and then be able to reinvest down once it has turned to bottom, and we can muscle our way up for another massive super cycle. So that is what's really, really exciting.
Markets don't move on logic alone. They move on emotion. Whether driven by tariffs, pandemics, or policy shifts, every major sell-off follows the same psychological pattern. Greed gives way to fear. Today's volatility mirrors past crises, not because conditions are identical, but because human behavior is. Investors often believe each cycle is unique, yet price structures repeat with uncanny consistency. Charts from recent corrections resemble those from 2007 or even the early 2000s. News provides the narrative, but emotion drives the action. Understanding this distinction is critical because it allows investors to respond strategically rather than emotionally when conditions turn hostile.
Obviously, we've got our tools to tell us when these gauges, when the market is changing trends. And of course, this is one thing I want to cover that I think is really important. And people always say, well, 2007, when it comes to the precious metal space, is nothing like it is right now. And my counter to that is, you're right. It is nothing the same. No bear market ever happens for the same reason. The selling, all of that, the economic conditions are always different. And if we take a look at this tariff crash, this is this year. We had the big sell-off February, March, into April, and then we had this giant rebound. And everybody was like, thought that was pretty unique, very specific. Well, if you actually go and you take a look at the top one, the tariff crash from this year, and then you go and you look at the COVID crash, you will notice a couple of things. They're both the same. Price goes up and down. It's either people are greedy and they're buying for growth, or they're panicking and they're selling from fear. It doesn't matter what the news is. When people hit the sell button, it's the sell button. It's the same thing, right? So this is what we need to understand is it doesn't matter what's going on in the economy. If there's good news, we're going to be on the long side, and the trend is up, we're going to be long. If it's bad news, whatever the news is, people are going to be selling and we'll be out of the market or in something going up. And that is the biggest thing I think people can understand is people get too concerned that this time is different and they think the market's going to do something totally different. And really the reality is it doesn't matter what the news is. Price goes up or down. And it usually moves in a very similar pattern, hence the reason why we use a strategy. Markets are just emotional waves of buying and selling, greed and fear, confidence and lack of confidence. So that's what we're going to be focusing on. And as many of you know, I've been talking about this Benner cycle for a little while. 2007 was a half cycle. There was only one major cycle topping versus 2000, the tech bubble, which was two major cycles topping out, which is why it was like a 3.5 year decline bear market. And we even saw precious metals and everything sell off in that time as well. During the first portion of that, 2007, we saw the same thing. Here we are in 2026. We have the Benner cycle putting in a major top as well, similar to 2000. So I think we're going to see some very, very interesting things unfold. And I'll try and cover some of that with my explanation of the comparison of 2007 to where we are right now. I should also mention it is the last few days of the year. 2025 is pretty much over, and 2026 is going to be, I think, absolutely nuts in a good way for us, in a bad way for most of other investors. So I want to quickly just let everybody remind you guys that I do have this ACS strategy, this adaptive compounding strategy. It is my most profitable strategy. If you just want to make the most money possible with the fewest amount of trades and the least amount of stress and volatility, especially if you have a very large account, 100K to millions, this is the strategy you want to deploy because it simply has the lowest level of volatility and it manages our portfolio risk. So it doesn't matter what size your account is, we can have steady growth through bear markets, through sideways markets, through flash crashes, COVIDs, little bear markets, all of that stuff. And we can knock it out of the park with some pretty big average annual returns with very small losses and drawdowns along the way. We got a bundle package right now that you get my sector trading strategy, which we've just closed out an SLV silver trade for 20% gain last week. You also get our long-term trading investing strategy, which is up 17% since its last entry early this year. And of course, a lot of subscribers are trading the 2X ETFs for some pretty big returns with one simple position on a year. And on top of that, if you go and check out our reviews, just go to our reviews site. We've got tons of reviews. This person here has been trading with us for 6 years, doesn't ever foresee leaving or canceling his membership. I mean, the testimonials go on and on about what we do, what we provide, and how it is life-changing and allows you to enjoy life, preserve your lifestyle, and grow your capital in all market conditions. And
long-term cycles offer a powerful lens for interpreting where we are today. Historical market peaks often unfold in stages, with divergences appearing before major declines. Current conditions resemble prior topping phases where markets looked strong just before rolling over. Unlike 2007, today's environment is complicated by concentrated leadership, especially in large technology stocks, which has masked broader weakness. Cycle analysis suggests we are approaching a critical inflection point similar to those preceding major downturns. While no two bear markets share the same trigger, they share the same outcome: capital destruction for the unprepared and opportunity for those positioned defensively.
We've got a big bonus here for New Year's. If you get involved right now and join our newsletter, I'm giving away free gold and I'll ship it to you with our ACS member, the bundle package. So I will send you a gold back, so it's real physical gold. And on top of that, you will get access to all the strategies. Plus you get into a exclusive live meeting with me. We all see each other's faces. We can talk the markets. We can kind of go over everything, find out what we have in common, and just have a lot of fun on a Zoom meeting call going forward. So if you want to do that, there's an hour-long call, and it'll be a lot of fun. So make sure you come to our website, subscribe if you just want to make money and not have to stress, and have some of your portfolio managed with a strategy that will do kind of take care of the risk for you. So let's jump over to the precious metal space, because that is where most of the excitement is. That's where all the money's flowing. That's where the emotions are. We've seen gold break out and start to run higher. It's starting to pick up speed to the upside. We do have some selling going on today. Now, we saw a drift higher going into the holiday season, which is typically what we see. As volume tapers off, big money and big funds and all that start to go on holidays, they do most of their selling beforehand. And then once they're gone, the market naturally drifts higher because there's a natural inflow of buying going on in a bull market, at least. If we take a look over at silver, actually, let's go and look at the gold chart here once real quick here. Let's take a look here at the monthly chart of gold. And this goes all the way back to early 2000, where we had the one super cycle take place and then it reset. And then it started a new super cycle in 2019, and I think we're going into a very similar. This red box is similar to the 2007 box in terms of we're going to see a price potentially spike up and then have a big correction, and then from there it is going to rocket higher up into around 7,500 or so. We're in this cycle here where that I think is going to unfold. The big question is, do we see gold actually get to 5,200? Now, I still am hoping we're going to get there. Problem is, everybody has that target now, and I'm not a big fan when everybody's gunning for it, for gold. So we might end up seeing the market top out a little sooner and catch a lot of people off guard. So that is what we need to be aware of. And when we show the comparison chart, let's pull up the comparison chart of, let me see if I can find it here. Comparison chart of 2007. There's some interesting price action going on. So the left chart here is the S&P 500 in the top. The yellow line is gold. And this is back, if you look down at the bottom, this is 2006, 2007. Recently, we've seen, obviously, the stock market and gold move higher together. And recently, we've seen everybody pile into gold miners, silver, platinum, palladium. They've all really popped and they took off. This isn't recently, sorry, this is 2007. And that was an early warning sign that the markets were getting very heated and could start to sell off. And if we start to go forward more, the stock market actually started to sell off, gold shot higher, and we actually ended up seeing everything else really pop and take off. Now, the stock market fell 20% here. Right now, we actually have kind of the same type of price action where things have actually gone parabolic, just like the last final push in 2007, except for this time the stock market hasn't rotated lower. And I was anticipating the stock market to sell off. That money dumps into precious metals and pushes them higher, and that still may happen. But we do have this problem where we have this AI bubble, we have Magnificent Seven, we got big technology doing most of the heavy lifting, and it has completely masked, I think, the sell-off that could have taken place. It's really held the market up. In my anticipation, I was naturally thinking we are here on the right-hand chart, meaning the market stocks were going to start to sell off, and then we start to see metals push even higher and have another big push. Now I'm starting to question that based on sentiment, based on price action.
As equities grow unstable, attention has shifted decisively toward precious metals. Gold has pushed into a new phase of its long-term cycle, accelerating higher after years of consolidation. Silver and platinum, however, have entered a far more volatile stage, characterized by explosive rallies followed by sudden, violent pullbacks. This kind of price action often signals late-stage enthusiasm and emotional participation. While metals remain fundamentally strong, extreme volatility is a warning sign. Historically, these conditions precede either sharp corrections or rotational shifts, where capital moves from speculative metals back into gold, the most stable and liquid safe haven asset.
And when we look at precious metals, if we go and take a look at silver, we're starting to get into that volatile state where we're having 11-12% rally followed by a very big sell-off the very next day. So if we just take a look here, you can see the market ran up over a one-day, 24-hour window, more or less 13% to the upside. And then today it has reversed down 11%. That is getting to be pretty extreme volatility. Big volume, that means there's some emotions, and that means capitulation. It could mean we're actually nearing the top. We did get close. Actually, I think we did. We had an $82 target was my peak, and we actually hit that in pre-market trading or last night. I'd have to look at the intraday chart, but we actually hit 82, and big selling has come down. So everything is pretty much in line with what we've been talking about and expecting. And just a reminder, it's been on my mind here, 43.8% of you that watch my analysis here haven't yet subscribed to my channel. So if I could ask you a favor to help out, if you like the content I share and you want to support the channel for free, a simple way to do this is to just hit the subscribe button and follow what we do and what I share here. My commitment to you is to try to put out more content that's educational, that's actionable. I do read your feedback and I share topics, and I'll cover more topics from what you guys want me to share and teach in these videos. So please subscribe if you like what I do here and share it. And thanks so much. Now, if we take a look at platinum, same type of thing. Everybody's super hyped in the space. We are having massive price swings. We're having like a day right here, it rallies 11%. And then we see a crash 9%. Then we see a rally 15%. Now we've seen it come down 11%. And even from overnight trading last night, it's down 12% in one day. So this is the type of price action that usually means we're getting close to the end here. And that is a big concern. And this is the problem with this type of price action, which I consider bubble territory, bubble price action, is it could reverse and rally straight back up and shoot higher another 20 or 30 or 40 or 50% for all we know. It could also collapse all of these, silver, platinum, palladium. They could collapse 20, 30, 40% very quickly as well. And that's why bubbles are so difficult. You pretty much have to throw a dart, try and ride that momentum, and then trim off, lock in gains. The nice thing is with our silver position for the band strategy, we've closed that out. We did hit our 20% target. We got in, we caught this run, and then we've moved aside. And now it's just allowing the market to shake itself out. It's very similar to our gold position that we took on, where we got into gold. Let me just zoom out a bit here. We got into gold right over here. We caught that 15% move. It hit our target. We saw some selling take place, and then it went into the capitulation, high volatility top, and then the market pulled back fairly significantly for gold. This is a very big pullback, a 10% pullback in gold, and then it's taken months here to digest and start to break higher. And so that's the same scenario. We're just kind of piggybacking, moving gold to silver, depending on what's going on. And gold here is much more stable and steady. We could see some selling in the other precious metals and people move over to gold because it's more stable and it's continuing to hold its value. And I think that could bode well for gold still. But again, in the big picture, everything is starting to show us that we're getting very, very close, I think, to the gold market actually starting to stall out. And I think the equities market is also very close to roll over and sell off. And once the selling kicks over into the Magnificent Seven, the general public are selling on a daily basis or weekly basis, bear market type of price action, the whole market is going to collapse and things will pull back.
Beyond metals, other asset classes are flashing caution. Bitcoin, once a focal point of speculative capital, has lost momentum, forming patterns that historically resolve lower. Energy markets, particularly oil, remain under persistent selling pressure despite short-term bounces, reflecting weakening global demand expectations. Meanwhile, real estate shows mounting stress. Affordability is stretched, buyer demand has collapsed, and prices are stagnating at elevated levels. These signals point to a broader economic slowdown. When liquidity tightens and employment weakens, as often happens late in the cycle, highly leveraged assets tend to reprice quickly and decisively.
Now, a quick look at Bitcoin. We talked about this kind of really brutal pattern before as a broadening formation. Increased volatility usually resolves to the downside. It has done that. It's been putting in a bearish pattern. You could argue this is even a larger bearish pattern. Again, it looks like it still wants to go lower. It's just lost its shine. Everybody's focused on either equities or they're focused on precious metals, and Bitcoin is just not part of the game. And if this does drop, it could have a very precipitous fall down to 65,000 or 60,000, catch a ton of people off guard for where that could go. Now, if we take a look over at crude oil, it's at a little bit of a bounce off this support level. We talked about how this is a very critical level. Naturally, it's going to try and bounce, and that's what it has done. It came right down to this level. It's had a bounce. It hit resistance. It's still ping-ponging around. I do think we'll eventually resolve to the downside unless there's obviously some news that's going to cause a rally that takes place. But there's so much negative bias and selling pressure in the energy oil space. I think eventually it's going to break down and we'll hit that $50, potentially $45 per barrel mark going forward. But the question is, we just need to wait. This is a long-term trend. It's taking its sweet time, and it just keeps testing this support level. Last but not least, let's take a look at the real estate market. Now, going back to the Benner cycle here, 2026 is the time where high prices should be sold into. You should be selling stocks in assets with value. And when we look at the real estate market, we can see here on average, the cost to buy the house, the cost to carry a house on a monthly basis is way above the median. And it is set and ready for a big type of correction, or at least a big sideways pause. If we take a look at the overall demand, the collapse of home buyer demand, we are down below where we were in 2010 and even over 2014, where no one was looking to buy homes. No one wanted to expand. And that's where we're at now. We're at this point here where if we look at the average price of a house, they've been kind of trading sideways, and people are about to start to let go of their homes for a loss or for a big decline. And that, I think, is going to carry over into 2026 and create that big reset that we've been talking about. So this is a year where we need to be very aware, protect our capital, and understand what is going to happen with specific assets. So again, when we take a look at the overall markets here, from a cycle, a economic and business cycle analysis, we're in this innovation and adaptation phase, and we're going to start to see the stock market top out. We're going to start to see bad news, economic data top out as well. And when all that starts to sell off, people are going to tighten up. This is when people will start to really lose their jobs, probably in 2026, 2027. And that's when homes really start to collapse in price because they can't carry the high values and all of that stuff going forward. So
as we approach the next phase of the economic cycle, preservation becomes more important than speculation. History shows that major resets are not sudden events, but processes, marked by rising volatility, asset rotation, and shifting confidence. The coming years may bring sharp declines in equities, corrections in real estate, and renewed focus on tangible stores of value. For disciplined investors, this environment is not something to fear, but something to prepare for. Those who protect capital, manage risk, and wait patiently for post-crisis opportunities are often the ones who benefit most when the next long-term growth cycle finally begins.